Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer, here to provide some comments on the third quarter and our expectations for the rest of the year. So the third quarter got off to a strong start with the S&P 500 reaching its highest levels since March of 2022. But markets took a step back when higher interest rates, fears of a bounce back in inflation, and a potential economic slowdown weighed on prices through August and September. The result was the S&P 500 actually experiencing a modest loss for the quarter, down negative 3.27%, and the higher yields pressured bond prices too, with the Bloomberg U.S. Aggregate Bond Index down negative 3.23% for the quarter. Getting into the reasoning, we believe several factors drove interest rates higher. First, Fitch Ratings downgraded U.S. sovereign debt, citing long-term risks to the U.S.'s fiscal path, sending Treasury bond prices lower and yields higher. We saw a steady increase in oil prices through the quarter, which had markets weighing how increased energy costs might contribute to upward pressure on inflation. And that dynamic led to a growing realization that the Fed may need to keep interest rates higher for longer in order to prevent inflation from becoming entrenched for the long term. And finally, markets are also grappling with the increased amount of Treasury bonds following the debt ceiling resolution in May. The concern is that the increased amount of Treasury bonds being issued in order to fund the federal budget may outweigh investor demand and cause Treasury bond prices to decline further. Despite the higher yields, though, we still have some positives to consider. Economic data has continued to be better than many have expected for longer than many have expected. Employment data, consumer spending, and business investment all remained resilient in the third quarter. Now, as we get into the final few months of the year, we expect that the labor market data, inflation, and interest rates will continue to be the main factors influencing the markets. Third quarter earnings could play a role as well if results show that consumer spending is weakening or that corporate profit margins are getting squeezed as a result of higher interest rates. And now, with the war between Israel and Hamas following the terrorist attacks in Israel, geopolitical risks are back in focus as well. Our team will be monitoring these developments through the fourth quarter, and that should help guide our positioning leading into 2024. Thank you for listening, and if you have any questions, feel free to reach out to your SFMG team. Thank you.